All right. So let me first quickly go through the question raised by Kritika. I tried to reply to her by email, but let me just make it clear since your exams are very near. Let's start this. So what you have to do essentially that you have two types of material in your syllabus. One is essentially the stuff, everything that has been covered in the class, including the post-class clarification sessions or Q&A sessions with a few students. Even that material is up because it's captured on video, so that's also up. That's also a part of the syllabus. That's one type of material. So the basic formula is uh, everything that's been covered in the class. That's one. And the second type of material that is in your syllabus. And so as far as what is covered in the class is concerned, the session-wise notes are intended to serve as a marker. All right. I don't know what exactly Kritika had meant when she talked about studying this, but these are meant to be just broad markers. I mean, the points that I'm discussing with you in the class, by and large, we try to maintain with 1 star here. This is a separate point. Okay. So whatever we are discussing, these are just very rough markers. Obviously, these notes are not sufficient because these are very just bullet point kind of notes. The actual details are given in the various hyperlinks. All right. So this is where we are, and this is where we are today. And so for okay, we'll still be discussing this. Same point is going to be discussed. So these are just broad markers as to what we are discussing. Right, so that's one type of material. And the second type of material that is in the course is the specific chapters from here, specific chapters from this, as I said at the very beginning. This is the ideal sequence of coverage of material, but we don't have the time to do it at this leisurely pace. But ideally, this would be the sequence of material. So what I have done is I have put in bold some of the chapters, which are also listed here actually. Somewhere in the session notes, you'll find that I have listed the important chapters for uh, as far as our project is concerned. Out of that long list of, yeah, so here on the 14th of August, we had listed. So what this is here is a selection from this ideal sequence of chapters. We don't have time to do all that. But the ones which are in bold, which are the same as the ones here, these are the chapters that better to go with this list because there's maybe some confusion with the bold marking here. So this list of chapters which you're supposed to do as this is a second type of material that is in your syllabus, which you're supposed to do as you're supposed to do it on a self-study basis. And then if you had any questions, you could have asked me, all right? So this is how you're supposed to do it. So these are the two types of material in your syllabus. And so hopefully anybody has any questions at this point? Yithika, are you here? Yithika is not here. Okay. All right. Anyway, so I hope it's clear to everyone what we have here. So let's go on with that having been covered. Let's move on to today's material, which is a continuation of what we had yesterday. So where are we? We are essentially, where we are essentially is going through all these different decision problems and working out a simple trading system, all right? A simple trading system using technical analysis. And as you know, a simple trading system helps you to solve the set of rules to solve all the decision problems that arise. So we've gone through this. And in the simple trading system, in addition to 1, 2, and 3, we only need to solve 4, 6.2, and 7. And 6.1 doesn't need to be solved. And for 5, we assume that every entry is at market prices. All right, so we are still on DP7, and that's the last DP that we are covering, and so that's where we are. All right, and so if you go back down to the end, this I have not pasted it here, but we just at this point when we are discussing this DP, we just go and click here, and that brings us to this point. Okay. Maybe we can put it here like this. All right. So we have all this. So as you know here, number of units, position size, this is not to be independently determined. This is a function of other factors, other variables. Position size is a function of all these. We have already done that. Okay, so in order to, what we're doing here is actually we are trying to model the position size because we're trying to solve this decision problem. How many units to buy, sell? Okay, the position size decision problem. Trying to solve that. So that requires a few steps. Okay, so initially what we have to do is we have to model the maximum risk per trade because this, as you can see, position size is a function of maximum risk per trade, exit and entry. And these exit is from 6.2, we already covered. Entry is from DP5 and also from DP4 because it gives you the side of whether you're a buyer or seller, etc. Okay, so from these three discussions which you've already had, you will figure out exit and entry prices. And then you have to know what max risk per trade is. So you have to model the maximum risk per trade. So this is one trick that you have to learn, which we've already done. It's a function of investable capital, risk capital percentage, okay, which is here in your notes. Okay, yeah. All right, so here we've already done the modeling of maximum risk per trade. So it's a function of investable capital, risk capital percentage, number of trades, and the percentage losers. All right, this is what we have here. And so that first, initially, to get to the modeling of position size, first you have to model the maximum risk per trade. Okay, so from these, so that's the first step. That's why I've written this here. Model the maximum. See, under the larger problem of derivation of position size, you have to first model the maximum risk per trade. You have to understand how that is done. Okay, for any trading system, for any period, you can model this as a function of these things. Okay, so you do that and you come up with a number. Like here we had come up with this number of 8108. Okay. So you come up with that number. How do you come up with that number? You make some very conservative assumptions. You make the maximally conservative assumption about the projected losing trades. It's a run of losing trades. Okay, so this is called a run. So if you have like heads, you're tossing a fair coin, you have heads, tails, then heads, then tails. So here we say that the longest run of heads is 3 because in a row you have three heads, maximum number of heads in a row. The longest run of, so we assume that you make the most conservative assumption about the run of losing trades. So we assume all the losing trades are stacked together, and based on that we come up with this derivation where what we do essentially is we divide the risk capital, the dollar figure, by the number of losing trades. Yeah. Okay. You can see here we've already done all this. We are just revising it quickly and just telling you where we are and how we get further down the road, where we go further down the road. Okay, so modeling trade P&L, model maximum risk per trade first, and then you have to model the trade P&L. Certain basic principles which we already covered in the previous class, very important principles to understand. And so one of the things you're going to do here when you're modeling the trade P&L is you're going to set this trade P&L equal to the maximum risk per trade. So that is your goal, that when you're trading, you don't want to lose more than your maximum risk per trade. So we set it equal to that, right? We could have set it less than also, but there are too many possibilities if you want to go less than that. So that's why we set it equal to, so that we have only one possibility. All right, so these are certain principles you must remember, that this PNL is always generated in the terms asset, okay? And that all trading is generally done in units of base asset. Generally, the reason I put in generally is because sometimes you can always ask for a quote in units of terms asset, but that is not normally how a market functions. Normally, when you have wholesale transactions between market players, big market makers and speculators, the trading is normally done in units of base asset. All right, so that's why I've given you this sugar trading as an example, for instance. If you ever forget this, so remember, none of this stuff is to be memorized. None of this stuff is to be memorized, okay? You have to understand the concept. And that's why I said here, if you ever forget, you think about how you trade sugar, you trade in, say, quintals, and all the profits you make, our profits are in rupees, because rupees is the terms asset if you're trading in India. Okay. So this is what we have, where we are, remember, our larger goal is to model the position size. Okay. But for that, we have to model the maximum risk per trade. We have to model the trade PNL, and we are setting the trade PNL equal to maximum risk per trade. Okay, so now we come to a situation which we have, we already started covering the previous, in the previous session. What we are going to do is, we are going to look at modeling of position size in 3 different situations, in 3 scenarios. And we are going to assume we are operating in the currency markets, because these situations are the most complicated in the currency markets, because you remember that this this principle, the trade PNL is always generated in the terms asset. Now, in general, if you're looking, if you leave out the currency markets, if you look at other asset classes, in all those markets for other asset classes, it's always true that one of the 2 assets in a market is always going to be a currency. But when you come to currency markets, it's more complicated, because both the assets are currencies, right? So it's more complicated. So we go with those currency market calculations, and if we can do these, then we can do the calculations in any other market. You have to remember certain things, that trade PNL in the terms asset, etc. So accordingly, what we do is, we have done a case in the previous session, but we'll start with the simplest possible case, right? Which is, we did what we did the other day was scenario 2, but we'll go through that once again. But now we are doing, I'll just start with scenario 1. That's the simplest. Okay. I may have duplicated the sheet here because we did this the other day. So anyway, we'll forget about this. I'll just move this to the back. I'll leave this in number of units. I'll leave it here. I may even remove this from here actually. But let's just focus on this number 2, the number of units. Okay. Is the font size big enough? Gaurav, can you see the font size?
Yes, sir.
Okay. All right, good. So you can read the numbers. So we're starting with the first scenario, which is the simplest scenario, which we did not cover in the previous session. Okay. So scenario 1 is, so remember, we are operating in the currency market, and what the larger objective that we have is to model the position size, okay, and to look at 3 scenarios for modeling the position size, all right? This is basically where we are. I've just written this twice. Put this in bold. This is what we are trying to do. So also get used to this language, okay? When, because there are a lot of now financial modeling has become a buzzword in the industry. So I'm not a fan of buzzwords, because people start using them without thinking. But since many people will be using it, so when we are using this kind of language, so get used to the way the language is used. So when we talk about modeling position size, means that